Hello everybody, my name is John Locke from lockeinyoursuccess.com and I'd like to welcome you to The Winning Trade. But first, the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you are aware of all your risks prior to placing any trades. Also note that in the presentation we are using hypothetical computer simulated trades. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Lock in Your Success LLC, where myself and my team are here to help you win in the markets and in life as well. Today, we're going to be taking you into the realm of high probability income trading. Now, high probability income trading is where we make money through the passage of time rather than depending on price movement in order to make money. Now, this doesn't mean we're going to make money all the time, but we will often make money whether the market goes up, down, or sideways. Now today I have a very special treat for you, especially for our more advanced traders, and this is an example of what we call professional style income trading. Now to differentiate from what we usually do, normally we come in here and we talk about non-subjective options trading strategies such as the bull trade or the M3.4U or the rock trade. And when we do these strategies, we are doing them what we call non-subjectively. In other words, we don't care if the market's going up or down. We don't care how volatile the market is. We just simply enter at a certain date. We manage the strategy as price movement and time goes by, and hopefully we end up at a profit. And if we end up hitting our maximum loss, we exit the trade. You can do this stuff non-subjectively, and you can have these very high probability outcomes, and you can do very well over time this way. But a lot of traders are looking for more consistency with their results, and they start looking for higher returns. Now, in order to do this, it's not really effective to go chasing from trade to trade, hoping you're going to find this perfect trade that wins all the time. As a matter of fact, that trade doesn't exist. Now, the reason we do these trading strategies in our Go membership, or these non-subjective strategies, isn't necessarily because we think the trader is going to, get a set of trade rules and try to trade that trade exactly the same for the rest of his life, no matter what happens in the future. What our hope is that the trader will learn to understand the strategies that we provide them. And once they understand the strategies and they understand how each strategy adapts or takes advantage of the marketplace or where its edge is in the marketplace, they then identify what's going on in the marketplace and then apply the strategies when it's best to do so and avoid strategies when it's not. Because the reality is there is no strategy that is going to, just make money all the time without any regard for what's going on in the background of the marketplace. That's also why our strategies they're designed to take advantage of different types of marketplaces. So if you go back to other winning trades, we have a bearish butterfly trade, which is designed to take advantage of a situation where you maybe you're a little bit bearish. We have the bull trade and the Super Bowl taking more advantage of when the market's maybe a little bit bullish. And then we have our more neutral strategies like a 3 where we want to take advantage of a more neutral marketplace. And each of these strategies will have their weaknesses. And by knowing what those weaknesses are and being able to identify when they might have a problem in the marketplace, and also knowing where their strengths are and being able to understand when their strengths are present in the marketplace, and you can match those together, you can win much more often. You can win more money, in other words, a better risk-reward ratio with your strategies. You can create strategies that are easier to trade and just much more effective for any given marketplace. But it does take that core first, right? It takes the core understanding of being able to trade those strategies non-subjectively for a period of time. But once you fully understand them and you understand when they work well, then you can go to the next step, and this is what this is now. So if you're newer, then you may want to go back to some of our more basic winning trade presentations, such as any presentation on the bull trade, the super bull trade. If you're a little bit more advanced than that, you can go into the M3.4U trade. If you're a little bit more than that, you can go into like the rock and the M3. If you're at that level, or you'd just like to see an example of this, then this is where you should be, okay? So again, our goal is to increase your returns and consistency through trading with the flow of the market and utilizing trader subjectivity with very high probability trading structures. This allows you to trade with flexibility and adaptability, and it allows you to make more money with less work and fewer adjustments. So when we do this strategy, the strategy itself doesn't necessarily have a name, although I'll usually give it one. And each strategy is going to be designed for a particular trading cycle. So we come in, we see what's going on in the marketplace, we bring up our expectation for trade entry. Are we bullish, bearish, or what? What do we expect to happen over the next 10, 20, 30, 40 days, however long we want the trading strategy to last? Given what we think about the marketplace and we know about our strategies, what kind of a return could we anticipate? Keeping in mind that we always have to trade according to what our exit loss trigger is. So let's say, I'm looking at the marketplace and I have $2,500 I'm willing to risk on this particular market cycle. So I set an exit loss trigger for $2,500. I take what I know about the strategies and I put together a plan to maximize the strengths of each trade and avoid strategies and adjustment types that probably aren't going to work out in this. And as new information comes into the marketplace, I'm just going to adapt. How much money can I make if this thing goes well? And my thought is that my anticipated return on this is going to be about 30%. Now, one of the things you might notice here is a lot of times on these strategies, we're going to have a profit target, and that profit target is going to be, say, 10%, and then we're going to have an exit loss trigger of, say, 10%. If you figure that out, we have a 1-to-1 risk-reward ratio. In other words, we are stopping out at 100% of what we expect to make, or the maximum amount we can make. When you do that with a trading strategy, you generally end up making on average 5%, and you generally end up losing on average on a losing trade about 8%. Meaning that in order for you to be profitable, you have to have like a 60% plus probability factor in your trade. Most of our strategies are up in the 80% range, and over time these strategies work out wonderful, right? It's wonderful. But we can do better than that. We can do better than that. We can still keep our 80% probability, but we can change our risk-reward ratio. We can put in an anticipated profit of 30% against a exit loss trigger of 10 or 11% in this case, and we can have like a 1-to-3 risk-reward ratio. In other words, our wins are almost 3 times what our losses might be. That allows you to have a much higher return over time and much better consistency over time if you can do that without affecting your probability, and we can do it without affecting our probability, and we can do it very, very effectively. And that is really the magic of this. Now, we teach traders how to do this in the M21 trading program. We teach you how to analyze the market and then make determinations where you think the market's going, and then how to apply the trading strategies of the bearish butterfly, the M3, and the rock trade in context with that market analysis. We also have the X4 trading program, which does the same thing. It shows you how to analyze the marketplace, make expectations about the market, and then construct a trading plan using the X4 trades to take advantage of what happens to be going on in the marketplace. So the same concept, just different trading structures. Here, once you've done that and you get beyond that level, you can literally use any trading strategy you know. So in other words, you use your knowledge to make probability decisions on where the market's likely to go and not likely to go over the next 60 days. You pick points at which things change. In other words, when we enter the market, we have a certain amount of information. As after we enter the trade and some time goes by, more information is going to be coming into the marketplace. Information that may invalidate our initial thoughts on where the market might go. So part of your trade planning is understanding where those levels are, and then if that information does come into the marketplace, in other words, we're projecting forward, if that information does come into the marketplace, what am I going to do about it? How are things going to change? Am I going to exit? Am I going to flip to a different strategy? What's the deal? So you want to have all that stuff planned out as you're going forward. So the trading structure I'm going to be trading today is going to be a high probability, high return, bearish butterfly, M3.4U hybrid strategy. If you don't know what either of those are, again, you go back to thewiningtrade.com and you can see the M3.4U that we trade and the bearish butterfly that we trade. So we're going to be doing this on the SPX. So I will show you how we plan to enter this. Our maximum trade size, by the way, 22.5, makes our exit loss trigger $2,500. And I don't really have a profit target with these. If the market's going well and the trade's going really well and we're up 30%, and I look at the probabilities and the market's behaving the way I think it's going to, it hasn't shown me any surprises, and my risk and price movement is still very mild, then I may hang in here. Right, I may hang in here and I may go for 40%, 50%, 60%. We've had 100% trades on this. Okay, so that could happen. But generally, my anticipated returns probably about 30% of something like this. And again, my exit loss trigger is about 2,500 bucks. So let's go back in time to October 15th, 2020. We are in a situation where I'm ready to enter a trade because I exited a trade from the cycle before. And if I take a look at the marketplace, I use my M21 or my X4 knowledge on how to read the marketplace and draw out my expectations to decide where I believe certain things are going to go. I set up my ladders on where, if new information comes into the marketplace, it's a problem. So my thoughts here coming in is the market's likely to drop out a little bit, and by that I mean, have a come down a little bit further, mild pullback, maybe like 3,400, the top of this cup here, and then it's likely to reverse to new all-time highs. That's kind of like my thought on the marketplace. Now, I'm also aware that that may not happen. Right? The market may go straight up. We don't know. The market may come down, and it may break down and test these lows, and it may come down and test these lows, and we might come into another, think what happened here last March with the pandemic. We don't really know, but the market does signal us when that information comes into the marketplace, and I want my trading plan to encompass what I'm going to do if any of those things happen to happen. So for me, I'm expecting the market to come down. I'm not really concerned with the market breaking down as in a crash, so to speak, unless we start breaking this 3,200 level, because this is an important level. Other than that, we'd expect a down move, then an up move. Now, the really good thing about these strategies is that they're high probability, and I don't have to be right. I just can't be too wrong. And then even if I'm too wrong, a lot of times I get out at a very, very small loss. So remember, our objective here is keep any loss we might have very, very low and go for those higher price targets or those higher profits. Okay, so here, since I'm thinking that the market is going to probably come down, I'm going to enter in bearish butterfly configuration. Now you'll notice this is not a bearish butterfly as in the bearish butterfly program, but I can use all the same concepts here. So a bearish butterfly in the bearish butterfly program is done on the Russell only. It's done with 50-point wings, okay? And I'm entering 20 points below the market, but market situations change. Implied volatility is different. We get different types of information when we enter a trade every single month, and certainly as time goes by, from year to year, it can change drastically. So here we have a situation where if you take this T+0 line, which is right here, it peaks out way back here, right? So I almost want to be ahead of the money with my butterfly, and I'm still bearish, even though I'm ahead of the money with a butterfly, because you can kind of see this. So I'm expecting the market to come down maybe 3,400, maybe 3,350, and then reverse higher. So I enter as a bearish butterfly, but I'm not trading a bearish butterfly. So there's a difference between an entry and a trade, and a trading strategy. So I'm initially entering bearish, but my longer term outlook is bullish. So what I'm trying to do is I'm trying to produce an entry where I can get up money relatively quickly, and then once I'm up money, it makes the whole rest of the trade a whole lot easier on the reversal should it happen. And even if the reversal doesn't happen, I sit here and trade this trade and it goes fine. And even if the market breaks down, I have a plan for that. So it's not like I'm taking a directional bet or on an equity or something like that, because I can be way off with this. The market may never go up. I can make money. Now, the only way I'm really generally going to lose is if I'm really wrong and the market takes off and starts, doing 100 points a day for the next 8 days. I have a plan for an up move, and we can see that coming, right? Because if you look at the price charts, if I get an up move and I break this high here, then yeah, that's bullish, in which case I'd want to flip out of my my bearish entry. That doesn't mean I'm going to lose the trade. It just means I'm going to restructure, and I got a kind of a poor entry on the position. But you know, trading's all about edge. I'm putting all the edge in my favor. I'm putting in the high probability edge. I'm putting in a little bit of directional edge to get a good entry, and then I'm also, during all my adjustments, I'm letting the delta go to certain points, maybe over what a normal trade might do, so that I get the edge on, you know, I take the anticipated market direction edge into the equation as well. And I don't even have to be right, but if I hit enough edges, it makes a situation where I'm much more probable to win the trade, and I'm also, when I do win, I can get much higher returns off of my money in shorter amounts of time. So here we are with 36 days to expiration. There's nothing magic about 36 days. I just happened to exit the trade, the last trade. And I decided to do that. Usually I decide to do that because I want more time, right? So if the market's moving around a lot, usually you don't want this type of a trade, you know, say 10 days to expiration if we're getting 100-point moves in the SPX, because they start to become sensitive to price movement, where if I'm 30 days or 50 days or 60 days, they're not that sensitive. So again, you know, I might just want a little bit more time in this, and you're going to see when I exit this that is indeed the case. So here we are, and let's just kind of go through this day by day and see how this goes. So we're anticipating the market to range kind of somewhere between, you know, maybe 33.50 and probably, what is the top of this here? The top of this is about 35.34. Okay, 35, so somewhere 35, 34 is right about here. So right in this range, we're anticipating it to go in this range for a little while. As long as it stays in that range, we don't have any problem. We are expecting the pullback early, which is why we're at negative delta. We're expecting a bounce later. So let's move on. And we're kind of getting the pullback. Okay, this is a bad data day. Let's kind of just go past this. We do get that in our software sometimes. Sometimes there's days where there's bad data. So let me just click into here. Luckily, they're not that often. So here we are, right? Our entry's going okay, and we did get our pullback. Now, as long as we stay under the 35 area here, we're not really going bullish yet. We're waiting for some sort of a signal that the market's actually going to go higher here, which I don't believe we get for a little while. Okay, so now we got our pullback that we expected. So here we are, and we're about 1400. All right. So a couple of things. If you've seen the bearish butterfly strategy in the past, or you know, well, actually we have newer guidelines for 2020 for the bearish butterfly strategy. So if you have the program, make sure you check those out. But a lot of times we'll roll the butterfly back. There's really no need for that, because if you look at my price chart here, we broke down further than we thought. I was kind of expecting this move down to 33, right around here, right at the top of this cup. That would be a normal move. We broke down off of that very hard this day, but we're not bearish yet. We're not bearish because we have a support level here at 3,200, and it wouldn't be too much of a surprise at this point for us to come down and touch 3,200 or so, and then maybe reverse. So since I'm still anticipating this, I may not be bullish at this point, okay, but I would expect the trade or the strategy kind of to stay in this range here now between 32 and 3,500, which is a very big range, but that would be our expectations. Again, we were wrong, but that's not a problem for the strategy, right? The market, in other words, a lot of times you're going to put these plans together and you're not going to be 100% right on them. So, you know, as long as you're not too wrong, everything's fine. But here, one of my concerns is that we get the market continues down, or the market kind of hangs down here, and I get a crush in my, what we call a crush in the T+0 line, where it drops a lot of value. So I want to support my T+0 line since it's right outside the tent. I don't want to get rid of the tent because I still think the market's going to be up at 3,500 or so later on. So I'm there's no reason to move this, but I may want to add something in here to support this line, and that's what I do. I simply add some calendars, or 2 calendars in this case, at the money. Now, what's the benefit of using a calendar? Well, when I get an 85-point down move in the SPX, the market usually goes into what we call backwardation. In other words, we get a very high implied volatility in November, and it doesn't go as high in December. And usually, one of 2 things is going to happen at that point. The market's going to stay crazy, and the implied volatility in December is going to pick up, and I'm going to make money. Or the market's going to calm down, and the implied volatility in November is going to calm down, and we're going to make money. So that makes this type of a scenario very good for a calendar as far as stability for your T+0 line. So here we are here, and I've done this. Now, we're just going to see where the market goes. I'm not really too concerned of another market crash. In other words, if we're going to get a market crash, I'm going to look for this to be below the 3,200 level. Until then, I'm just going to assume it's going to hold range. So here I go to the next day, and we get a bit of a bounce, but we're kind of still in range of our calendar. There's really nothing to do here. All right, so now we get a 68-point down move, and we pull past the calendar, meaning a continued down move is going to hurt the calendar and it's going to hurt the butterfly. So I'm just going to come back, and I'm going to move this calendar back to at the money here. So you'll notice it's at 3,300, and I'm going to ignore trades, and that's going to bring this all the way down to 3240. So now we have this position here. Like I said, if I had reason to believe that the trade wasn't going to be in this range, then I might do a rollback here, but I don't. But everything is fine here. There's no issues whatsoever. So let's just move forward. Okay, we get a big bounce, and we get outside our butterfly here. And this is an anticipated bounce too, right? Because this is now doing what we expected. We came back down, we tested this support point, and now we're starting to bounce. So we're outside the calendar here. So I'm just going to bring the calendar forward again and bring it back to at the money. Again, supporting our T+0 line, keeping things stable. If we go to Tuesday, we got a 68-point up move. This is what our position looks like. Again, I could either exit the calendar at this point. It would be okay to exit it, or I can bring it back to at the money for try to get one more bite out of it. And the reason I might want to do that is if the market stalls, I can get a pop in my profit and loss. So I come in and I bring this up to here. Notice our maximum capital in this is pretty much under $20,000 the whole time. And this is where we look here. If you look at our price charts, we're making the move up towards the top. Especially, at this point, usually when we get a V reversal like this, we have to anticipate retesting the top of this here. Okay, so let's move forward. We get an 80-point move. Now, here is the situation. We're back in the tent. We don't need the calendars anymore. Let's get rid of them. We're also bullish at this point until we get up into this range here of 35.11, and then we really don't know where the market's going to go. Usually when that happens, what's going to happen is the market's going to back off a little bit and then explode higher, and then we can set a price pattern target off of this U, but we really don't know. So what we're going to do is we're going to go more neutral here. We're going to go into M3.4U position. In other words, we're going to get rid of these calendars, and then we're going to take these long strikes and we're going to roll them back until we're within M3.4U parameters, which is a maximum of -15 delta. And here we have -1.24 delta. In other words, we neutralize the delta by pulling off those calendars and taking these calls here and bringing them in forward or in closer to our short strikes. And now we're in M3.4U configuration. Now remember, we're looking for around $600 to $6,500 or so in this. That's about 30% of our planned capital. So we come to this day, and we're only up $4,400. Our M3.4U Delta guidelines, by the way, if we're neutral, I use those guidelines a lot, is minus 15. So I'm going to want to make an adjustment here. I can bring in my long strikes to do that. So I bring my 3560s down to 3550. And that brings me to a delta number of flat again. So now I'm neutral delta. So once we get up into this area here, we are expecting a stall in the marketplace. Usually when we get a stall in the marketplace after such a big move, we'll get what we call a pop in our profit and loss. So as the market's moving a lot, the implied volatility tends to resist dropping. But as soon as it starts to stall out and the market goes into a little bit of indecision and people don't know where it's going to go, then a lot of times it'll drop out and the profit and loss will pick up. So that's what happens the following day. So I'm going to take off the trade here and go to the next day. So here we are, Friday the 6th. 30% of 22.5 is, I think, $6,700, I think we said. We're at $6,200 profit. The market's not exactly doing, it didn't exactly do what we thought it was going to do. Some time's gone by where we had a nice valuation pop this day, right? We had the first day of a stall. We had a good valuation pop. We're in the center of the position. We're in a charting pattern where we're not sure which way this is going to break. And we could get a big move either down or up off of this. So all those things taken into consideration, generally being 14 days to expiration, I'm going to want more time. And this is what happened the last cycle also, right? I got to the point where I wanted more time. I got a nice pop in my T plus zero line or in profits, and I took it off and I went off into the next month. And that's the exact same thing we're going to do here. So we're going to close this at almost a 30% profit. That's probably about 28% of our planned capital. And it looks like we were only in here. I think it looks like I think we entered 36 days to expiration, so it would be 22 days. So that's 30% in 22 days, and the market didn't even really do what we were expecting it to do. So it was definitely different than what we thought, and that's what I call a fantastic trade. That's very flexible, very durable. And then from here, what I do is I plan my next trade, and this just happens to be entered about the same way. Again, we're at a point where we have a market stall. We don't know which way it's going to break. If it breaks down, chances are that we're going to come down like we did before, probably only part way if we go down and then go higher. And if we don't and we just go higher, then I can manage this as an M3.4U and just shift this into positive delta if we end up going outside the 10. And that's pretty much what happens here. This trade works out well, as is the trade before it. So that's an example of a pro-level adaptive income strategy. This episode's winning trade. If you like what you see, I encourage you to come on over to lockingyoursuccess.com or thewinningtrade.com and discover how you too can follow along with this and many other great strategies as they unfold during our Options Trading for Income weekly webinars that we have on Monday mornings. Also, where you can learn about our upcoming winning trade presentations and explore past winning trades and receive access to lots of bonus material. And while you're there, make sure to check out our free Trading Performance podcast, where you can get information to skyrocket your trading regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on this video below so we can get those answered for you. Thank you for joining me, and I look forward to seeing you on the next winning trade.